Hello, everyone. Welcome to the seventh lecture of Management 202. Hello, everyone. Welcome to the seventh lecture of Management 202. And so in this class, we're going to continue talking about the IPO of uh, Hello, everyone. Welcome to the seventh lecture of Management 202. Right. So in this lecture, we'll continue talking about external financing, right, in terms of IPO for companies who wish to raise public equity capital, right, for the first time, right, from a public stock market. Okay, so remember in the previous lecture, we talked about private equity investing, right? We talked about different type of investors. We talked about the valuation process, right? And also we talk about the different ways for exiting a private equity investment for the investors, right? And we start a little bit about IPO, talking about the cost and benefits of doing IPO in the first place, right? So why it's an important decision for the company and what it can bring for the company itself, right? And also why many companies, right, although they have satisfied the public listing requirement, still remain private, right, as a company's format, and never did any public equity offering, right? And also some firms became public, but changed back to being a private company. Why is that, right? Because there are certain costs and for doing IPO, right? For staying as a public company, right? So we have talk a little bit about costs and benefits for doing IPO, and then we started talking about this Uber's example and explaining the process of doing IPO for different companies, right? So in this example, right, to remind, we talk about the different informations, right? First of all, we introduced the concept of an underwriter, right? So remind that I used the example of a real estate agent, meaning that doing IPO for the IPO firm, right, to sell its shares, it's very similar with selling a house, right? Selling a house. You need to engage an agent which can help you value your company, right, and also market your company to investors, and then help you sell the shares, right? So in this case, the agents are Goldman Sachs Group and Morgan Stanley, who are investment banks and act as underwriters for underwriting the IPO shares of Uber in this case. Right? And then we introduced the IPO market, right? We know that a lot of times, right, the science behind doing IPO is to take advantage of the market sentiment on your company, right? You want to go in at a point of time when people are enthusiastic about the type of your company, right? So you want to come in when people are fascinated about technology, if you're a technology company, and you don't want to come in when people are relatively poor, when they lose job at a very bad economic state. That's not the time for you to do an IPO, right? Because the market is pretty bad at that time. And if you do an IPO at that time, it's not very likely that the market is going to give you a lot of money for your shares, right? And then we talk about the investors, right? So here is, think of this as example of exiting your private equity investment for private equity investors, right? Like a first round capital who invest a lot in Uber's first two rounds, and another example, which is a benchmark, right? So, and also think about this as an example of the rate of returns that you can get out of your private equity investment, which is quite fascinating, right? So let's continue to talk about another example of IPO, which is about Twitter, right? So both Uber and Twitter are, very well-known companies who have gone through the very similar process, which is the IPO process, right? So this article is also on the front page of Wall Street, right? Which says that the Twitter's IPO price at $26 a share, right? So let's take a look at some of the information in this article. Okay, so in the first red box, it says that the price of 26 is available primarily to large investors such as mutual funds and hedge funds, as well as some of the individual clients of the banks underwriting the deal, right? Meaning Goldman Sachs, right? Led by Goldman Sachs Group and other investors. Okay, so what does that mean? Right, so if you think about this, actually it means that actually the price is not a universal price that's available for every investor, right? And instead, it seems like the companies or the IPO firm and the banks actually will have a sort of a discrimination on different type of investors, right? So this $26 price is only available to large investors such as mutual fund and hedge funds who can provide a large amount of capital and buy a large bulk of the shares from Twitter, right? From Twitter. So this is exactly what happened, right? So think about buying oranges or buying apples, right? In the farmer's market, right? The more you buy, right, generally the less price, right? The better discount you can get on the product. Right? So this is very similar in this case, right? So if you buy more, you get a lower price, right? And who are the people who are going to buy more of the shares, right? It's not you, it's not me, right? It's not the retail investors in the in the stock market. It's actually the institutional investors, those mutual funds, those pension funds, hedge funds, right? So those are big players that's going to eat the cake at the lowest price, the large part of the cake at the lower price, right? And then the second box says the bank aims to place the bulk of the shares with a relatively small number of long-term investors, right? Like we explained. And the last box says that retail investors, right, meaning you and I, okay, including customers of some online brokerages and brokerages affiliated with the investment banks, right? So even though you have connections with Goldman Sachs Group, you still cannot get the share price of $26 because you are a small player, right, in the market, right? So we're slated to receive less than 20% of the offering, right, at a higher price, right? It didn't say, but which is true, right? So what does this mean, right? It tells us several very important information about how companies will do IPOs, right? So first of all, it has different type of customers, right? Big players, small players. You can define it in these two types. And what happened is that different type of investors will get different type of prices, right? Will get different prices on the amount of shares, right? Based on the amount of shares that they acquire from the IPO firm and the underwriters, right? So big players get more shares, right? Pay more money and get lower prices, right? And vice versa, right? So this is what it means, right? And another thing, right? Another thing it implicitly said is that, first of all, the IPO firm and the underwriters will engage large shareholders, the large institutional investors. Okay, they will first talk to them and then sell the rest of the remaining shares to retail investors or to the general market. Okay, so there's sort of like different steps in terms of approaching investors, and there are different prices, right, given to different type of investors, right? So how do the companies actually do that, right? Is through something called roadshows. Okay, so let's take a look at this page on Investopedia about roadshows, right? So what is a roadshow, right? It's similar with the concept of singers and performers and bands, right? Doing shows across the countries, right? So it's a word adopted from this, right? So a roadshow in here in the IPO context means a series of presentations made in various locations leading up to an initial public offering, right? In other words, the roadshows are basically the companies and the underwriters doing a tour across the countries, trying to attract interest from different investors across the countries, right? So right now, probably you don't need to physically travel all the way around the country. What you're gonna do is that maybe do a Zoom online meeting, right? And make a presentation of your companies and introduce your companies, market your companies to large institutional investors, to basically the fund managers, right? And tell them that this is a very good investment for a company, and you should buy my shares, right? So this is basically what roadshows means, right? And who is going to be present in the roadshow? It's not retail investors like us, right? It's the big players, managers, right? The managers of mutual funds, managers of pension funds, right? So large institutional players is going to participate in the roadshow, and the company and their underwriter will do a roadshow first, right? We'll do a roadshow first. And the roadshow is not only important for the company and the underwriter to introduce, right, themselves to the market, right, to the investors. It's also important because the investors will also give feedback to the company, right, in terms of how interested they are, right? Meaning that, well, if I'm interested in your company, let's say I'm a mutual fund and I want to buy Twitter's shares, right? I like the idea of Twitter and I think it's going to generate a pretty good profit, right, for my fund. Okay, so I'm going to buy it, but I'm going also to tell you that the price that I'm willing to purchase and the amount of shares that I'm willing to purchase, right? So from collecting the demand or the interest, right, from a variety of institutional investors, the roadshow will give the underwriter and the IPO firm some understanding on how interested or how enthusiastic the market is, right? The general market is to the IPO firm's shares, right? So roadshow is important, right, in both sense, meaning that first of all, it is important for the company itself to introduce themselves to the market, right? Second of all, it's important for the IPO firm to collect information from the market on how they should price their shares, right? So during the roadshow, the company and underwriter might discuss and reconsider their strategy in pitching their shares to the market. Right? So this is why this is interesting. This is very important for the IPO firm, right? Because after all, you're going to sell most of your shares during the roadshow, right, to the roadshow investors, not to the retail investors, right? So let's take an example of roadshow, right? So here lists the example, right, which is about the Chinese e-commerce giant Alibaba. Okay, so this company posted the largest IPO ever, raising this amount of money in 2014, and the underwriters took home $300 million, right? So meaning that the underwriters did a pretty good job in selling the shares and get a pretty good reward for helping Alibaba selling the shares, right? So the IPO was so successful, stock price surged in its debut, but enthusiasm for the IPO began well before the stock began trading, right? So the roadshows include financial numbers, but also a video history of the company, right? So the roadshow was such a successful with investors that is likely the reason why IPO range was increased, right, to 66 to between 66 and 68 from the earlier published number of 60 to 66, right? So what it means is that after the roadshow, right? So Alibaba and their underwriters realized that this share is going to be very popular, right? And this share is going to be very popular because there are a lot of demand for the company, right? They learned from the roadshow. Okay, so what you're gonna do if you think you're gonna be popular, you increase your price, right? So if higher demand, higher price, right? So if the demand is higher, then a good strategy to do is you increase the share price, right? You increase the share price to take advantage of the high demand, right? So this refers, back to our point that roadshow is important, right, for adjusting your strategy, right, adjusting your share price, to sell your shares. Right. Okay, let's go back. And this is from the one page of Wall Street Journal, right, which has a lot of important information on Twitter's IPO. Right. So let's take a look at another page, right, which says something that's quite unrelated. Right. This paragraph says Deborah, right, a 50-year-old administrative assistant in Chicago, right? She says in an interview on Tuesday that she messed up in not buying Facebook last year. and hopes at least to buy 50 Twitter shares on Thursday through her Ameritrade account. Right? She's interested in Twitter, she said, because of her nephew and because she doesn't want to miss out on a potential successful stock. Right? Even as the 140 character message service often used on smartphones is largely foreign to her. Right? I don't even use it. You know what kind of phone I got? I prepaid. Okay, so this kind of reminds me of the example of Jeff Bezos' parents, right, in making the decision to invest in their son's Amazon, right, company Amazon. Is that a lot of times investors they don't know much about IPOs, right? They don't know about those companies at all. But it's interesting to see that sometimes, or a lot of times, right, people will have this impression that IPO companies generally perform very well, on the first couple of days, right? So for a lot of companies you have seen, right, they have probably surged like the 20, 30, 40%, right? Sometimes even more than 100%, right, in the first day of trading, right? In the first day of trading. So many people they are quite enthusiastic in investing in those IPO firms, especially at a very very early time, right? Right after they get publicly listed. Okay, so we will talk about why this is the case, right? So one of the things we'll talk about is called underpricing, IPO underpricing. Okay, and we'll talk about why, or whether it's right or wrong, right, for an investor like us, right, or like Deborah, who makes the decision to buy the shares when it's first publicly listed. Okay, so let's go back, right, and rethink about the IPO process and think about who are involved in the IPO process. Right? So we of course have the firm who wants to do IPO, right? It's called IPO firm, and this firm will engage these underwriters, and a lot of times, right, in general, what's it gonna do is that it's gonna sell the shares to the underwriters. Okay, so it's gonna sell the shares to the underwriters at a discount, and the underwriters will be responsible for selling those shares, for reselling these shares, right, to the market. And sometimes, if the country is specified, right, it will allow the underwriters to return the shares that they did not sell to the market, right? They did not get to sell to the market um, back to the IPO firm. Okay, so we'll talk about IPO contract in the next slide. But here, I want you to understand actually how it works is that you first sell the shares to underwriters, and underwriters resell the shares to the market. And a lot of times it involves a large discount for the price that you actually sell to underwriters, right? So think about selling your house, right? Think about selling your house. You actually pay, right? The seller actually pay the agent who helps the seller to sell the house, right? So if you have bought a house before, you know that as a buyer, you don't pay your agent. Okay, as a buyer, you don't pay your agent. The agent's money comes from the seller, right? So what it means is that you have to. It will not make sense if you sell the house at the same price because you lose money, right? Even if you sell the house at the price, the exact same price you buy the house, because at the time when you sell the house, you are responsible for paying the underwriters the underwriter fee, right? So how would the underwriter or how would the agent earn the fee, right? So normally the major fee comes from the discount, right? The discount you sell the house to the agent, right? So for selling a house, you don't really sell the house to the agent, right? But the agent takes maybe like 6%, right? 5% of the house price that gets sold, right? That gets sold at. Right? So this is very similar, right? Meaning that actually for IPOs, right? IPO firm sell the shares to the underwriters at a discount, okay? Let's say 6% of the price that the underwriter is going to sell it to the market. Okay, so very similar with selling a house in this case, right? So the higher amount of price that you actually sell your shares, then the higher amount of money actually the underwriter can earn, right? In this case, right? So what would the underwriters do, right? They are typically investment banks like Goldman Sachs. They provide valuations for the IPO firm. They buy it at a discount and they sell it at a higher price, right? So what they do is that they help the IPO firm perform roadshows, collect the demands, collect information from the market, and they sell the majority of the shares to the large institutional investors, and the rest to the retail investors, right, on the stock exchange. Right? Or sometimes they can give it back to the IPO firms if the contract allows. Right. So also these are the two parties on the selling side. Right. On the buy side, we have two types of investors, which we talk about: roadshow investors, right? Mostly institutional investors like the big funds who promise to buy more of it at a lower price and hold it up for longer, right? And on the other side, we have retail investors who get to share the rest of the cake, right? The remaining part of the cake after roadshow investors. But we typically are at a disadvantage in the price that we are offered, and also the amount of shares that are available to us. Okay, all right. So the process is like this, right? The IPO process is like this. First of all, the seller engage with the agent and determine the contract, right? And determine the contract. There are three types of contracts, right? So I'm not going to go into the detail of each contract, but I want you to remember, most of all, right? Most likely it's going to be either a firm commitment or best effort basis, right? So more commonly it's going to be a firm commitment, meaning that underwriter will purchase the entire issue at a agreed price and sell it to the investors at a higher price. Okay, so if they enter into a contract like this, then Twitter will sell. Let's say Twitter wants to sell $100 million shares, right, in its IPO. Then basically the Twitter, right, they will first determine the offer price, right, to their investors. Let's say the offer price is between 26 to 28. Okay, and then Twitter will sell the 100 million shares to Goldman Sachs at a discount. Let's say like a 7% discount, right? Meaning that the Twitter will sell the bulk, right, all 100 million shares to Goldman Sachs at a 7% discount, right, of $26 to $28. Okay, and then now Goldman Sachs will hold all those shares, right? And the job for Goldman Sachs is that to try to sell these shares to the market at a price between 26 to 28, right? And if it's success in doing that, they pretty much earned underwriter fee of 7% of 26 to 28, multiplied by 100 million shares, right? Multiplied by 100 million, right? So this is the amount of money that the underwriter has earned from Twitter, right? So if it's for a second type of contract, which is best effort basis, then there's no commitment for underwriter to purchase these shares, right? So in this case, it's like it's like selling a house, right? The agent will try to sell your house at the highest price as it can, but it doesn't promise you to sell it. Okay, so if the house has remained on the market for 3 years, for 4 years, it's not the agent's issue. Okay, the agent promised to sell your shares at the best effort of him, right, of her, right? But he doesn't promise you to sell everything. Right. So in this case, for the underwriters, they don't personally hold the shares for the firm, or sometimes they buy the shares, but they get the right to return the shares, return the remaining shares if they don't all get sold. Okay. So last type is a bit special and rarely seen, right? More rarely seen than the first two types. Firms and underwriters will actually attract, right, or solicit bids, right, from investors. Right, meaning that let's say mutual fund X is interested in buying Twitter shares at the price of $28 for 5 million shares. Okay, and then mutual fund Y is interested in buying Twitter at a price of $27 for $2 million shares. Right, so it will pretty much rank those bids from every investor that are interested in, right, from top to bottom, right, and they will start selling the shares, right, to the top bids, right, all the way down to the bottom bids, right, until they have exhausted all the shares that they want to sell, right. So this is less rarely seen, right. So sometimes it makes sense to do this type of IPO if the firm is really popular with market, right. A lot of people wants to bid on it, the bidding price will be much higher than actually the price of the shares, right. So in the case of Alibaba, right, it will probably make sense for them to do an auction IPO, right, in that case. very high enthusiasm from the market. A lot of people wants to get in for this type of stuff, right? Then it makes sense to do an auction IPO, right? Because think about this, right? So let's say we have like artworks auction, right? Artworks auction. You're trying to sell a very popular painting from Picasso, right? Then if no one is interested in Picasso anymore, right? Then you won't sell at a very high price, right? So it only makes sense for the agent to do an auction on something. If the agent knows that the market is super, optimistic and super, if the painting is super popular among the investors, right? So this is also sometimes you don't see auction IPOs very often because it's not like the best way, right, to pitch the IPOs, right? Okay, so overall, right, you want to know that the first two types are most commonly seen, right? The first one is normally what happens, right? Because in this case, the IPO firm is more guaranteed, right, to raise capital from the market because the underwriter pretty much have already given money, right, after they made this commitment. So first of all, right, first step, engaging underwriters. Right. Second step, agree on the valuation, right? Agree on the offer price. And third price, notify the SECs, right? So we need to acquire approval from SEC for going on IPO, right? Because after you do IPO, the company essentially become under the regulation of SEC, right? Under the regulation of SEC, needs to comply with different rules formed by SEC and also by the stock exchange that it get listed on, right? So it will to notify the SEC with the intention for an IPO, the company needs to file something called a prospectus, right? Prospectus, or in many cases called a red herring, right? Red herring for its intention, okay? And during this process, right, because price can change, valuation can change, it will sort of make changes to this prospectus. And in the final stage, after they have successfully, did an IPO, right? They will file the final prospectus to SEC's approval. And then right after notifying SEC, they will start a roadshow and do a book building, right? So in this case, book building means learning the demand, right, from all interested roadshow investors, right? So build a book of all the demand, right? And then they will adjust its strategy, adjust its sale price and offer price, right, and determine the underwriter spread, right, on the determined offer price. Okay, sorry about my cat. Then finally, well, it will first sell it to the roadshow investors, right? Remind that those large institutional investors, and then it will sell the rest of them, right, to the public on the stock exchange on its IPO day, right? So there's something called over allotment allocation, right? It means that if the IPO is very successful, meaning that all the shares that the trader wants to sell to the public are exhausted, right? Then it will be something on the contract that allows the underwriter to sell even more shares of the firm, right? For the firm to issue more shares to the public, right? Because remember that the more shares the underwriter get to sell, the higher payment is going to receive, right? From doing this IPO, right? So this over allotment allocation is sometimes specified in the contract between the IPO firm and the underwriter to encourage the underwriter to make better efforts in selling the shares. Okay, so some IPO terminology here, right? What do we know? The underwriter is basically the agent, right? It buys the issue of the security from the issuing company, right, in the first contract, and resells it to the public, right? So some terminology is called like lead underwriter, right? Sometimes if you have multiple underwriters, you will often have a lead underwriter, which is the main underwriter, right, who leads this IPO process, and is often also the underwriter that buys the largest amount, right, from the firm and takes on the highest amount of risk. right? So syndicates means that there are multiple underwriters doing this stuff together, right? Which is called underwriter syndicates. The spread, right? The spread is pretty much the difference or the discount, right? The discount that the underwriter, oh well, sorry, the IPO firm sells the price to the underwriter at, right? And the spread pretty much determines the underwriter's fee, right, for selling the house, right? It's typically 7%, right? And it's larger the issue size, the smaller the spread, right? Meaning that the larger company it is, normally you will have a smaller spread because because the share is already right, the issue size is already large, right? Then you will potentially make more money, right, for a large share issue. So in this case, often the spread is smaller, right? And also because a lot of times if the value for the firm is very large, right, it means that the firm is actually a pretty popular firm, right? Then it's less of a work for the underwriter, right, to market the company to the investors, right? So prospectus is a summary that provides information on the securities issues, and we talk about roadshows. We talk about book building, and we talk about over allotment allocation, and sometimes it's called a green shoe provision, right? So a lot of concepts over here about IPO terminologies, right? So it allows underwriter issues up to 50%, 15%, right? More of the original offer size if offering is successful, right? So this sometimes can be seen in a contract between the two parties, right? As encourage, right? As encouragement for underwriter to do better jobs, right? And finally, there's a primary and secondary offering. Okay, so primary offering, right, means the new shares get sold, right, that raise new capital. Right. Secondary offering means that existing shares are sold by the current shareholders. Right. So there are no new shares created, right. But you want to remember that for IPO, actually, new shares are created and get sold. Right. So this is what we call a primary offering. Right. So remember, for private equity valuations, right? Each round, when there is a new investor, right, joining the investment of joining as one of the owners, right? We create new shares, right? We create new shares to the new investors, right? Right. So IPO is same, right? IPO is very same. We create new shares to be sold during the IPO, right? So this is what primary offering is, right? For secondary offering, right, if you're selling your existing shares that has already been created, right, basically there's no creation of new shares. It's just the existing shares are changing hands, right? Then it's called secondary offering, right, not the primary offering. Okay, so this is what the prospectus for Twitter looks like. Okay, so it has a list of information on what the Twitter is about, and the valuation of Twitter, right? And at the bottom, it lists the 3 underwriters who are responsible for selling Twitter's shares, right? Right. In this table, it lists the initial public offering price, which is $26, right? And lists the underwriter discount, which is 84 cents, right? 84 cents, 84 cents, right? So if you do a calculation, let's see. In this case, it's not that much, right? The under spread, the spread is 0.845 divided by 26, which is about 3%, right? So which is about 3%, right? So for companies that are relatively large, then sometimes and relatively popular already, right? So you don't need to do much to introduce this company to investors, right? So in this case, the underwriter spread is relatively small, right, to the average spread. But however, it's still about 3%, right? Meaning that $100 you sell it to the market, right? You only raise 97, right? Less than $97, right? You pay the $3, right? Pretty much to your underwriters, right? To those 3 companies, right? As a compensation for their work. Okay, so IPO hit the front pages very often, right? Not because they raise, not only because they raise a lot of money, right? But also because we often observe a very curious stock price pattern, right? Right after it get listed, right? And often, a lot of times, if you hold the IPO firms for at a longer horizon, you will see that actually their performance their performance actually sucks. Okay, their performance actually sucks compared with stocks that have already been listed for a while. Okay, so we're gonna talk about something else about IPO facts, right? On top of the process for doing IPO, right? So we're gonna hopefully explain, right, and understand IPO better um, after we talk about these four perspectives of IPOs, which we call it IPO puzzles here, because sometimes it's sort of against the common sense for people's understanding on IPOs. Okay, so the first puzzle is called short-term underpricing, right? Essentially, it means that IPO stocks generally exhibit a large price increase right after it get listed. Okay, this is a fact, right? So a lot of times you observe a very high surge on the stock price of firms that that gets immediately get IPO. Okay, immediately after the IPO. Okay, the second puzzle, right, which is curious, right? Because if you think about this, why would there be a short-term underpricing? Because if you think about it, where companies wants to sell their shares as high as possible, right? They want to raise as much money from the market as possible, right? Because if they sell their price at if they undervalue their shares, then they pretty much issued their shares at a lower price than they should have been raising, right? Than they should have, right? Then it's very bad for the existing investors to do that. Right? So why would we observe this short-term underpricing or a high surge for the price right after its initial listing, right? Which is kind of puzzling to academias, right? And the second puzzle is what we call the long-term underperformance, right? So why would IPO firms, relatively to companies that have already been publicly listed for a while, why would their performance be worse, right? If the IPO firms are those very hot firms, why would they perform at a lower, give a lower return in the long horizon, right? At a relatively long horizon, right? And the third one, which is sort of puzzling, is that there are actually very strong cycles for the IPO market, right? Remember that we talk about the IPO market as notoriously hot and cold, and from what we observe on the numbers of IPO, right, or on the total amount of money raised from IPO, the cycles are even stronger than how the market looks like, right? So why would that be the case, right? And finally, right, it's sort of hard to explain why companies would be willing to go through such a costly process to raise money, right? Because a lot of times, you have to pay a lot of money to the underwriters, which makes this IPO process very, very costly. Okay, we'll talk about why companies are willing to take so much money, to spend so much money to get publicly listed. Okay, so these are the four puzzles of IPO. Let's start talking about the first one. Right, so this is the performance, right? This is the performance for Twitter and Facebook right after their IPO from day 0 to day 28, right? Pretty much, a month and a half, right? So remind that we have, about 21 trading days, right, for each month, right? So let's see, yeah, 4 weeks, we have 5 trading days each week, right? So about 20 trading days, right, each month. So 28 is like between 1 and 1.5, right, trading days for Twitter and Facebook, right? So this is how their prices are right after their IPO, right? So it means that if we invest $1, right, or if we invest $100 in Twitter's IPO right after it get publicly listed, we will earn a lower, or actually will make a negative return by investing in Facebook's IPO, right? Because after 28 days, or even alone any days after within the 28 period, right, 28-day period, we will have a negative return by holding this Facebook investment. However, if you look at the Twitter's IPO, right, right after it gets listed, if you let's suppose you get in right after it gets publicly listed, then your return will be about about more than 100%, right? Which is above 200, right? You will get about $200, right? At the end of the 28 days, right? Meaning that you'll get a more than 100% return, right? For holding it for 28 days, right? So what does that mean, right? What does that mean, right? The first day of Twitter's IPO, really high surge, right? However, it's quite quite calm, right? Quite peaceful for Facebook's return on the first day, right? On the first day, and then starting from the second day, it tanks, right? It actually drops, right? So very high, very high contrast between these two stocks, right? Why would that be the case, right? Why would that be the case, right? So if you invest in Twitter, right, for like Deborah, if you get in early, very early, then you could potentially, right, reach a return, a very high positive return. However, if you get in Facebook, it's actually not like what you imagined, right? You will actually see a negative return after its IPO. Why would that be the case, right? Why would different companies have such different reactions on the stock price right after it get listed? Okay, so let's take a look at an article and see what the article has said, right? So in the end, it seems like Twitter avoided Facebook's IPO mistake. Okay, so look at this right now, right? So first of all, it points out that maybe Facebook makes a mistake in IPO, and let's read on and see what the mistake is, right? Which is overpricing. Okay, so he believes that the article's author believe that Facebook has made an IPO mistake, which is to overprice its shares. Okay, so if you overprice your shares, what's going to happen is that your share price will drop, right? Your share price will drop after your IPO, right? So it says that Twitter avoids Facebook mistake overpricing by making another mistake, which is underpricing. Okay, so what happens after underpricing is that if you underprice your shares, right? Let's say you did a share offer price at $26, while everybody believes that it should be maybe around $28 or maybe even around $40. Right? So what's going to happen after that? Everyone is going to buy your shares, right? Which will drive up your share price, right? Which will, deliver you a high return after this, right? So let's see why it seems that both of them have made a mistake, right? Either price overpricing or underpricing, right? So to figure out which is worse, one needs to remember what the goal of initial public offering is, right? So what's the goal of it? Right? Normally, a company goes public in order to raise money that can be invested in the company's growth. Right? By pricing its IPO very high, Facebook squeezed every dime out of the investors waiting eagerly to get in on the hottest IPO of all time. Right? So everybody knows Facebook. Everybody probably owns a Facebook account. Right? Then people are all very interested in Facebook's shares. So this is what Facebook determines to do, right? Facebook squeezed every dime out of the investors, right? Meaning that it overpriced their shares because it knows that investors are going to be so enthusiastic in its shares, right? So this is why it prices shares high, right? So the company ended up raising more than $16 billion, right? $1 billion in return for a lot of bad publicity and some disgruntled investors, right? So think about it, right? Investors paid a lot of money for your shares because they think, it's the hottest IPO ever, right? However, what actually is that Facebook actually priced the shares too high, so that the return for the shares is actually low, right? So think about this for its existing investors, right? What will happen, right? So let's say it's existing investors hold the shares, right? And then after the IPO, the shares price have tanked, right? So the existing investors will not be happy, and also the ones who participate in buying the shares first get listed on the public stock exchange, right? So they have observed a negative return, so that's why they will become disgruntled, right? Disgruntled. So Facebook actually use this strategy of overpricing, right, to get as much money as they want, but the feedback is bad, right? Bad reputation, right? A lot of bad publicity. Right? On the other side, right, Twitter chose the opposite route, selling 80 million shares at $26 a piece. The company raised 2.1 billion when it easily could have raised more. Okay, this is very important, right? So there are different strategies this company take, and they're quite opposite, right? One company takes advantage of, the popularity and raised as much money as it could, right? By some extent of overpricing, right? However, Twitter, right, the other company, has chosen the opposite path, right? Underpricing the shares, getting a lot of good reputation. However, at the cost of losing amount of money that could be potentially be raised, right? So this is what we this is how we understand IPOs, right? So a lot of times you see an underpricing of a company, right? Because the companies wants to get some good reputation in IPO. Okay, so having a high surge in its price on the first day of trading, a lot of times is very attractive. Right? It's very attractive and can bring positive impression on your companies, meaning that investors who get in the investment will actually be rewarded, right? So you make a good impression with investors who are interested in your company, right? So this is what actually happens in the data, okay? Because IPO first day return on average are known to be high, right? Almost 14% on average, right? This is normally done, right, purposefully by the company, right, by the way of underpricing, okay, by the way of underpricing, right? So the potential explanations are the following, right? Investment bankers can sell more at a cheaper price, okay, can sell more at a cheaper price. That's just generally true, right? Lower lower price, higher amount, right? So it's just economics 101, right? So investment bankers, right, remind that if they have signed a contract with the IPO firm, right, like the first type of contract, firm commitment, right? So if they have signed a firm commitment contract, then what they want to do is try to sell as much shares as possible, right? Because the rest of the shares they have to keep it themselves, right? So if they don't want to keep a lot of shares, they better get rid of the shares as much as they can, right? So what they do is that they can price it at a lower, right, slightly lower price, so that they can sell more of it, right? And the more you sell, the more money you can raise, right? The more money you earn, right? So sometimes the bankers, right, or the underwriters are believed to be taking advantage, right, to take advantage of entrepreneurs by pricing this offer price at a low price, right? Because think about this, they can actually price the shares like Facebook, right, which is at a higher price. However, what they do to Twitter is that, well, they tell Twitter that let's do it at a lower price than they should be. Okay, let's do it at a lower price they should be, and we can get a really good reputation. And for my personally, I can get rid of those shares as much as I can, right? So sometimes this is sort of like believed as an agency issue, right? Meaning that bankers have their own incentives of trying to sell as much shares as possible, or as many shares as possible, so that they actually talked the IPO companies, right, into an agreement with a lower offer price. Okay, with a lower offer price. And sometimes the IPO companies, right, the IPO firms, the founders are happy with it. Right? Sometimes they're happy with it because at a lower price, their company can get a better reputation, right? But the cost is that you don't raise enough money, right? You don't raise as much money as possible during an IPO. And remind that the purpose of doing IPO, right, first of all, is to acquire capital from the public stock market, right? And if you fail to do that, then you potentially increase the cost of doing an IPO in the first place, right? So, and second explanation is that, right, a second explanation is that having a first day return generate more interest in the stock, right, as we explained, right? So information asymmetry explanation, right? What is information asymmetry? It means that different people have different information on the same thing, on the same subject, okay? Different information on the same subject. And a lot of time it means that one party has more information on one subject than the other party, right? So this is like what we call information asymmetry, right? So informed investors, meaning that investors who know more about the share price, right, have an information advantage on top of the uninformed investors, right? So it means that some investors, right, to the market, right? So if let's say you're trying to sell your house, right, to the market, right? Some people know more about your house. Some people know less about your house, right? So the people who know more about your house is more willing to give a better price to your house. However, people who don't know your house is willing only to give a lower price, right? Which is quite normal, right? But for IPO firm, you want to attract as much interest as possible, right? You want to raise as much money as possible from everybody, right? So to induce the people who know less about your company, you want to issue at a lower price, right? So that they feel comfortable in buying it, right? So that they feel that they're buying it at a reasonable price, right? Okay, so this is like selling used cars. Okay, so if you sell a used car, you know what's going on with your car, but people who are interested in buying does not what has been happening to your car, right? Maybe it has been involved in an accident, but they never know, right? So in order, right, for them to be comfortable in buying something that they do not fully know about, right, you need to give them sometimes a discount, right? That's why secondhand cars are usually sold at a discount than their true value, right? Because you need to induce the people who don't know everything about it to be willing to pay for it, right? So selling your shares, right, in the IPO is similar, right? Sometimes, right, in order to sell more of it, you want to give them at a lower price, right? You want to give a discount on the price of it so that people who don't know much about it is willing to buy it. Okay, so these are a couple of different explanations on the happening of IPO underpricing, right? So hopefully we can learn from this the fact of underpricing on some theories, right, on some concept or logic behind this underpricing, right, which is quite important, right, which is quite important in corporate finance, right, quite important. Information asymmetry, and um, investment bankers have different incentives than the IPO firm, right, and also to attract interest, right, to attract interest from the underpricing. Okay, so here's a table, right? Here's a table summarized by Professor Jay Ritter at the University of Florida, right, in a 2015 paper, right? He pretty much documented all the IPOs, right, on the major stock exchanges from 1980 to 2014, right, to 2014. In terms of the total numbers of IPO, right, the equal weighted returns of IPO, meaning that you sum all the returns together, the first day return of all the IPOs together and divide it by the number of it, right, and also the proceeds weighted return, meaning that for IPOs that have raised more money, you give a higher weight than the IPOs that have raised a lower amount of money, right? And then if you do a weighted average, like what we did with the WACC, right? If you assign different weights on different IPO returns in the first day, proceeds weighted return is something like this, right? It's something like this, right? So for proceeds weighted returns, it gives a higher weight for companies who have received a higher amount of proceeds, right? So it's another angle of looking at the returns, right? Which is adjusted by the size of the IPO. Okay, and the fourth column shows the aggregated amount left on the table, meaning that this is the aggregate amount of money, right? On the table means that it's paid to the underwriter. Okay, it's paid to the underwriter without going into the pocket of the IPO firm, right? Pretty much. There's another way saying on the table, right? So this is basically shows the amount of money that gets paid, right? That underwriters get paid, and versus the last column, which is the aggregate amount of money that gets paid to the IPO firms. Okay, to the IPO firms. So what you observed here is that in different years we have a very high difference, right? Very large difference in terms of number of IPOs, in terms of the amount of money that had been raised, right? So in 1980, it's very different from 1981, right? So that in 1981, twice as much, right? More than twice amount of firms get publicly listed than in 1980, right? And then if you look at year 2001, which is when dot-com bubble has bursted, right? Dot-com bubble has bursted. Only 79 companies were publicly listed versus in 2000, 381 companies have been listed, right? So a large different variation in number of firms that get listed. If you take a look at the returns, right, the equal weighted and the proceed weighted returns, very high returns, right? You never get any negative returns for the first day return of IPOs, right? In general, right, the example of Facebook is very rare, right? A lot of other cases is that companies generally are underpriced, right? Meaning that they earn a very large return in the first day of publicly listed, right? And if you look at the table, which we will talk about, if you look at the fourth column, which we will talk about later on, you see that underwriters are paid very handsomely for doing their job, right, on IPOs, right, for doing their job on IPOs. Sometimes, right, take a look at 2000, right, year 1999 and year 2000, 31 versus 64. What does that mean? So many firms are trying to get listed, right? So many firms are trying to get listed, and they're willing to pay so much money to the underwriters, right? Out of $100 that they acquired, they pay $37. They pay $37 out of $100, right, to the underwriters for getting publicly listed, right? This is such a handsome return, right, such a handsome payoff, right, for the underwriters in specific times, in specific point of times. Okay. Let's continue, right? So the first puzzle, right, I want to remind you is that we talk about IPO underpricing, right, which is sort of like strange, right? If you think about why companies want to actually underprice their shares, right, when doing when doing IPO, right? So, and a few potential explanations, right? There's no agreement, right, and the different explanation have their own evidence, right? Probably in different times and for different companies, their strategies are different. Okay. And if we know that IPO firms tend to underprice, right? Should we follow Deborah's suggestion, right? Should we follow Deborah in in forming a strategy that we pretty much want to keep track of IPO firms and invest a lot of money in the first day of all IPO firms, right? So if we know when firms are going to do their IPO, right, which is public information, and let's all invest in all the firms that do IPO. Would we achieve a gain on Twitter like more than 100%? Like 100%, right? So basically, does the Mrs. Watkins or Deborah's strategy of investing in IPO companies make sense? Right? So yes and no. Okay, yes and no. So the no part is that normally you are not the person who can get the first hand on the IPO stocks on its first IPO trading day. Okay, normally you see the surge, but the surge is caused by people who have connections or people who are institutional investors who have connections with online brokerages, who have connections with the underwriters that buys the IPO at the earliest time, right? So in other words, as a retail investor, it is very difficult for us to get a first hand on the IPO, right? On the IPO stock right after it's publicly listed, right? So at the time that we can actually buy the stocks, the price has already been surged for a large amount, right? So it means that while you can probably still get a return for IPO stocks, right? Investing in IPO stocks, but it's not as as large as we observed in the data, right? We can never get a return as handsome as what has been documented on the IPO return in the first day, right? In the data, okay. So remember the roadshow and book building stage, right? Institutionals are the main customers. They have already purchased a large amount of, IPO shares, right? And it is them, right, who will drive up the price on the first day of trading, right? So underpriced IPO shoot up in the first minutes of trading, right? And it's very hard for us to get involved in investing in the IPO, right, on the first day to take advantage of the mispricing, right? So if you think Deborah's right, then probably you're wrong. right? So the overall conclusion is that yes, the first day return is very attractive, but it is very hard for us to realize that return ourselves. Okay, so what if we follow a long-term, long horizon strategy, right? So what if we invest in IPO firm in longer horizon, for example, holding it for I don't know, like 3 years to 5 years, right? So the long-term performance is in the data. What we see is that actually IPO firm sucks. IPO firm suck, right? IPO firm really suck in the long horizon, right? And it is explainable, right? It's explainable, right? Because think about it, right? So one thing that we talk about, right, for IPO, for firms doing IPO is that they will want to do IPO when the market believes the price of the IPO firm is high, right? So they want to do IPOs. They generally do IPOs when the market has a highest valuation about a company, right? So what's going to happen after that? Market will lose interest on the IPO firms, and their valuation will drop, right? So they have to take advantage of the high valuation during an IPO. And normally, what happens after that is that market will, generally have a lower valuation on the firm. So in the long term, right, the overpricing will actually turn into a negative return for those companies. So this is why in the long term, right, IPO stocks actually perform relatively worse than the stocks that have already been publicly listed. Right. So the third puzzle is that the IPO markets are very cyclical. Okay, so even after considering the states of the markets, okay, the cyclicality itself is unsurprising, but the magnitude is super volatile. Okay, if you look at if you compare with the market, right? So this is a graph showing the number of offerings and the proceeds of the offerings, right? Similar with what the data has the data provided by Professor Jay Rader, right? So this graph shows that we have a very volatile, right, number of offerings, right? If you look at the red dots, right? So up and down, very volatile, right? And the proceeds, right? Sometimes you have a very low proceeds, right? Look at the year 2002, right? Look at year 2002. Compare with year 2000, year 1999. Right? Such a high difference, right? Such a high difference, and the changes can be really high, right? Depending on the year. Right? So even if we have accounted, right? Even if we have accounted the year of the economic status, right? There's still very very high differences between across the years, right? On the number of IPO listing and also the proceeds, right? Generated by the IPOs. And the last puzzle I want to talk about is that even facing, right, even knowing that IPOs are very costly, still a lot of companies decide to do this, right? Still a lot of companies decide to do it, right? So first of all, think about it. First of all, you need to pay a lot of money to underwriters, right, as an IPO firm. Second of all, you know that your price is going to be underpriced, right? So it even adds more to the cost of your of going public, right? Of going public, right? So first of all, you pay a lot of money to the underwriter. Second of all, your prices are going to be underpriced, right? Meaning that you can get an even lower amount of money from the capital market, right? So in this graph, right, it shows the total direct cost, meaning basically the cost you directly, the IPO firm directly pays to the underwriters, right? Plus, plus the legal fees, right? The auditor fees for hiring, right? A lot of different costs together. Right? A lot of times, right? So for this graph, it shows in different bins, right? So it separate IPOs by the amount of issue proceeds, right? Basically, the amount of size of the firm, right? So the first bin is for companies which is less than 10 million, right? Received less than 10 million proceeds from the market. Right? So for these are small firms, right? So for those small firms to be publicly listed, look at it. The IPO for IPOs, right, which is the red bar, the cost is as much of 17% of the total amount of proceeds that you have received, that you are going to receive, right? So it means that out of $100, right, you received, you need to pay $17 as the direct cost, right? Which is very, very costly, very, very costly. Okay, and different colors of the bars represent different type of assets, right? So the second bar is about SEOs, meaning that the not the first time of issuing public equity, right? The subsequent equity offerings, right? It also very, very costly, right? Standard bonds, and convertible bonds. Right? So for bonds, if you want to issue bonds, right, you need to follow a similar process. You also need to hire an underwriter for you to do it. Right? You also need to hire an underwriter for you to do it, and you need to pay the underwriters a bunch of fees. Right? So it's very costly to engage in this process, right? Particularly for doing IPO and the SEOs. Right? So if you want to learn more about IPOs, right, his website has a lot of information on IPOs, right? So this is one thing that, well, you can think of as a puzzle, you can think of it as a fact, right? So if you don't think it's puzzling, if you think it's reasonable that companies do IPOs, right, for their own purposes, then think about this as a fact, right? IPOs are very, very costly. A lot of firms decide to go into this procedure regardless of its cost. Okay, so then a couple slides about season equity offerings, right? Well, the information are similar with IPOs, and I want to support, right? I want to provide this information, right, in support of IPOs, right, in support of the initial public offering. You're free to take a look at it, but I will not discuss it using the class time. Right? Maybe we can talk more about it in the live session, and SEOs will not be in the quiz or in the, it will probably be in the homework, but it will not be in the quiz. Okay, so it's good to know more about it, and let me think about if we want to discuss it in the live session, because I think it's also important, right, and be helpful and supporting in understanding SEOs, right? There are 3 SEO puzzles, right? Similarly with IPO, right? Long runs underperformance, right? Also very costly, and there's a stock reaction to SEO announcement, which is sort of negative, right? Negative signal to the market. The stock price will generally drop, right? And I'll leave this to you to take a look at it. And if you have a question, right, we can discuss it in the live session. Okay, so this is about the second part of equity financing. And let's stop here for this session, and we'll continue for the third part in the next class. All right, thank you.